Hi, everybody. This is Josh Jalinski, the Financial Quarterback, and we are live, joined by special guest Stan Harley, Chief Market Strategist of Wealth Quarterback and Harley Market Letter, author of a very popular newsletter, and he's back in a rare Christmas and Happy New Year gift to our listeners. You've asked for him. Now here he is, Stan the Man Harley. So,
hello, Josh.
So Stan is away on vacation, and he joined us. So Stan, many of our listeners are clamoring to know, what is your latest market update? First, give us a rundown of what happened in the markets this week thus far.
Josh, the work that we're doing at the firm suggests that we could be near a very important cyclical high. A lot of cross currents going on. There are some developing divergences. We had a sharp move up. We have a sharp move down. Now we're seeing the markets push higher once again. And I think there's a very good chance we could see the S&P push to a modest new high tomorrow, maybe the day after Christmas. And that might be the only index to go to a new high. And then we would have our divergences. And that would be sort of the icing on the cake, if you will, to form a top. We've got some charts here that we're going to share with the audience and talk about. But there's a very, very compelling evidence of a significant high developing right in the present time frame.
Wow. So, Stan, for those who are not familiar with the work you do for our firm, do you want to describe what you do for the firm?
Yes. I am the Chief Market Strategist for the firm, and I look at all things related to the markets with a special emphasis on quantitative and technical analysis. And that means we look at a lot of data sets. We do a lot of statistical and regression modeling. We look at charts of the benchmark indices. We look at charts of all the stocks and the ETFs in our client portfolios, and run a lot of indicators and a lot of fairly sophisticated modeling, put it all together, and we come to a quantifiable decision as to whether or not we think the markets are likely to trend higher or trend lower. And equally importantly, if not more importantly, we want to be predictive and be prepared for the highs and the lows before they occur. And so that's kind of where we are right now. We're at the point where the markets have run up for quite a period of time. They've moved up quite a lot in price. And the evidence right now is very, very compelling for a significant high in the making right here as we speak.
Very interesting. So a high would then portend a low. When do you think we'll make new lows?
Well, we've got some charts I can share with the audience here shortly, but want to get the high in the rearview mirror. But I think we could be looking at a fairly sharp decline. I think it's going to surprise a lot of folks. And a decline over the course of the next year, I think, is very, very plausible.
Okay, man, it's quite the news. So, Stan, what makes you think we are headed for lower lows, or what makes you kind of pessimistic?
Well, we have a particular cycle on the monthly charts that I was going to show here in just a moment. But the major peaks over the last 60 to 70 years have occurred at roughly 7-year intervals. And that's been a fairly consistent cycle. In fact, it hasn't missed a beat. And we are right in the heart of the envelope for the next crest in the 7-year cycle series. So that tells me to be alert right in the present time frame. Now that timing function has a standard deviation of about 6 months. So what we want to do is we want to look at a number of indicators. We want to look at potential divergences among the major benchmark indices. And if we have those, that makes the case very, very strong for a compelling market peak.
So you're generally bearish right now, what other things are you seeing in the economy as well? What about interest rates?
I think we're sort of at that point in time where we're going to see a major shift in the things that we have been accustomed to. That is, we have been accustomed to a bull market in equities. We have been accustomed to a bull market in Treasury bonds, or conversely, a bear market in interest rates. And I think we're right at the point where both of those are shifting here. I think interest rates have probably already turned the corner. They probably bottomed last year. We'll get into some of the charts here shortly, but every 40 years, Josh, plus or minus a year or two, interest rates have had a historical tendency to make a major pivotal turn. 40 years ago, we saw the peak in interest rates in the latter part of 1981, and here we are 40 years later. So we are right in the heart of the envelope for a 40-year cycle turn in interest rates. And I think we probably saw the low in interest rates last year, and they have turned the corner, and they are now slowly starting to step their way higher. So for money managers and for investors who are accustomed to buying the dips in equities, buying the dips in Treasury bonds, our work is going to be cut out for us going forward here, because I don't think it's going to be quite so easy. I think the easy money is behind us. Doesn't mean it can't be done, but it's going to mean that it's going to be much more challenging as we go forward here.
Now, what about to those who say, actually the last 6 to 8 months, the market's been rather choppy, and really the low is right around now, and then we may have higher highs in a very strong 2022?
I understand the points that those people are making. The problem is the indicators that measure degrees of overbought and oversold are stuck to the ceiling right now, or certainly for the S&P and for the Dow, the New York Composite, the NASDAQ. They are just a little bit off the ceiling, but they're not anywhere close to being down into oversold territory that would typify an intermediate cycle bottom. So the structure is just not there. So it's hard for me as a technician to make the case for a bottom here, because we just don't have the ingredients in place to define that sort of a bottom.
So what do you mean by structure? What in particular are you referencing?
Oh, technicians use indicators that measure price velocity and price range. And an indicator that measures price range, for example, looks back X number of time units and then looks at today's price on a percentage basis as compared to where it has been historically within that time unit. So, for example, if we look back 100 days and found the highest high and the lowest low, and then looked at today's price on a relative strength basis between 0 and 100% of that range, one would find that the dots are right near the top of the page on the screen. And that's what you expect in a bull market environment when prices are heading higher. Conversely, when a market is moving down, those dots in the spreadsheet start coming off the top and they start moving to the lower part of the page. And then when we get to a cycle bottom, they're literally right on the floor. We don't have that. We just don't have that. We don't have it on the daily charts. We certainly don't have it on the weekly. And for heaven's sakes, we don't have it on the monthly charts either. So we don't have that type of technical structure like we had, for example, back in March of 2020, almost 2 years ago. We did have that then. We don't have that today.
And folks, when we return, we'll be back with Stan Harley showcasing some of his charts and what his latest work suggests for real estate as well. When we return, this is Josh Jalinski, the Financial Quarterback. And folks, call us for a special Christmas and New Year's gift to you, and you'll get the Income for Life Blueprint. And Stan has been so generous to offer 45 minutes of his time to those of you who schedule and keep your no-obligation review. So call us now, 888-988-JOSH, 888-988-5674, 888-988-JOSH. We'll be back after this. And we're back. This is Josh Jalinski, the financial quarterback, with Stan Harley, chief market strategist, former Top Gun naval pilot. Do you have a master's in aerospace? You have an MBA, and you have a degree in aerospace engineering. So you're what do you call it, a rocket scientist?
I guess so, Josh. Yes.
So let's talk, while you're getting the charts up there, let's talk about this first presentation stock market chart called The Geometry of an Evolving Top. And let's go into this one.
Yes, this is kind of the theme that I thought we would share with our listeners on the radio and our viewers on the YouTube channel. The work, as I said, is very, very compelling for a top in the making. Of course, for our viewers on YouTube, they can see the chart here. This is a synthesized chart of the S&P 500. And for for the people listening on the radio, I'll describe what we're looking at here. But what we've done here is we've synthesized data from the Dutch, the British, and the American market, and produced a composite S&P 500 index going back all the way to the year 1600, all the way through the present. And this is a log chart. You can see prices have steadily risen over the last several hundred years, and right now we're in the mid 4,000 range for the S&P 500. What I thought it would be very beneficial to examining would be the monthly chart, something we talked about in just a couple of minutes ago. And for the people on YouTube who can see this, this is a chart of the S&P 500 going back to the early 1960s, and all of the major peaks, every single one without exception, can be defined by a cycle that approximates 7 years. It's about 83 months. And for the listeners on the radio, what we're looking at is a chart of the S&P, and it reflects all of the major highs: 1996, 1973, 1987, 2000, 2007, all the way through.
Can you re-enable sharing? Because I think for some reason it just has your title screen. Yeah, there we go. Okay, can you blow that up a little bit for our listeners?
Absolutely.
For viewers?
Absolutely.
Okay, so this is a chart dating back to 1966, and you would contend that every 7 years there's a high. Some of those highs, though, to be honest, don't really look like highs. They look like blips.
Well, this is a log chart. So if one were to look at an arithmetic chart, the declines from those tops, certainly real time, would appear much more pronounced. But we're looking at a log chart, so it's compressed by the base factor of 10. So it's a little bit, shall we say, deceptive, but nevertheless, it conveys the message here. And that is significant highs in the stock market, certainly since the early 1960s, have occurred on a fairly regular beat, Josh, approximately 7 years. Sometimes as short as 74 months, sometimes as long as 94 months. When I compute the central tendency of that data series through what's called regression modeling, I found that the regression constant works out to be 83.3 months. Let's call it 7 years, close enough for government work. And what the modeling says is we are right in the heart of the envelope for the next recurrence in this 7-year cycle. And the standard deviation on that is about 6 months. So that says anytime between now and, say, 6 months from now, we should expect to see the next high point in this cycle.
Interesting.
Let's take it down to a little bit lower time frame to the weekly analysis. And what we have here, Josh, is a weekly chart of the S&P 500 going back about 40 years.
It still says monthly, so if you could re-enable it. Anyway, so you can just hit stop sharing and then share again, maybe?
Okay, I'll try that.
Yeah, there we go. Cash
data.
index. Here we go. Cash S&P 500 cash index weekly. Go ahead.
Okay, great. Okay. Um, what that is showing, of course, is the fact that the market has moved up a lot. A lot. I mean, it's going almost pure vertical in the present time frame. And that's a little scary, shall we say. We have never seen this type of slope going back, oh my gosh, 89 years maybe. It's almost going straight up right now. Doesn't mean it can't go up another 20% over the next year or two. But the evidence from the cyclical perspective would suggest that's unlikely, very unlikely. Let's take a look at the daily chart here.
Now, what about people who say, well, this is nice, past, obviously past performance is not indicative of future results, but, that was then this 7-year cycle. I obviously saw it in 2000, saw it in 2008. 2015, people kept talking about the 7-year cycle, but really, it was a drop of, say, 15%, wasn't a major crash. Everybody was worried about that one. I think that was when, we even had you on the show. We were all kind of concerned about that then 7 years ago, more like 6 years ago, I guess. But, that really wasn't a true, I don't know. I think, the market went down 15%. That's not like cataclysmic. That's not like an '08 style loss or a 2000 to 2002 loss. In a way, if you're saying 1994 was another high, that was sort of like that one, where, you go 7 years before that and you had the 1987 crash. But, what if we just have this 10 to 15% garden variety correction next year? Is that off the card? Is that off the table? What do you see? For case in point, if the Dow is 36,000, Dow's right now 35,753.89. The market loses 20%. Market loses a significant amount. You're at like 29,000 Dow. To me, that's not the end of the world. It's probably a garden mill, garden variety correction like we saw in December of 2018, where it was a scary month for sure. The market went down 20% in a month. But some of these, I guess two questions. One, that 2015, 2016 number was kind of not that steep of a drop. What do you make of that one first?
The cycles tell us what is likely to expect on the x-axis. They tell us nothing about what to anticipate on the y-axis, which is price. And the more significant declines have occurred when this cycle has coincided with some longer-term cycles. That's when we typically see a greater magnitude in the decline from high to low. But what the decline will be from here, I'm not attempting to forecast that at all. What I'm suggesting here is that 7-year cycle is due right in the present time frame. And it just means that we need to be cautious about how we manage the vulnerabilities from the long side. And that's about it. That's about all it can tell us. And once the market
it's telling us caution. So it's telling us caution, not magnitude. So that's interesting.
Exactly.
So, folks,
I'm not here to tell you anything about the decline that's coming. I'm just here to tell you that there's a 7-year cycle. The likelihood of a 7-year cycle crest is at hand, and that's about all I can tell you as a market technician.
Interesting. So, folks, when we return, we'll be talking to Stan about gold, real estate, and more of his exciting charts when we return. And, folks, call us right now for a special Christmas and New Year gift. New Year, new you. Get your free review and you get the Income for Life blueprint at no charge when you schedule and keep your no obligation review. Call us now, 888-988-JOSH, 888-988-5674, 888-988-JOSH, 888-988-JOSH. We'll be back after these messages. And we're back with Stan, the man Harley, and we have a special technical producer, Jim Nesto, from the office. Does a great job managing the office shenanigans of the team, and he's a friendly face for many of you, so thank you, Jim, for stepping in. Ernesto, we hope you get better soon, although Jim's doing a great job. So go ahead, Stan, what's your next chart? Take us to the chart universe.
Absolutely. I pulled up a daily chart of the S&P 500. Are you able to see that on your screen?
Not yet.
Well, okay. Let's see what's going on here. Maybe we'll need to make that happen here.
Well, while you're doing that, what are you thinking about the gold market of late?
Before I go to that, I thought I would stay on the stock market for the moment here, Josh. We have some divergences that are developing that I wanted to bring to our listeners and our viewers' attention. And that's how tops are made, typically made. We have divergences. It's unusual to see everything turn on a dime. In the first part of November, on the 2nd of November, the Dow Jones Transportation Average made its then all-time high. 6 days later, on the 8th of November, the Dow Jones Industrials, the Russell 2000, and the Advanced Decline Line made their all-time highs. That was almost 7 weeks ago. On the 16th of November, the New York Composite Index made its all-time high. A month ago, on November 22nd, the S&P 500 and the NASDAQ Composite made their all-time highs. Here we are, very close to Christmas. We are right at the winter solstice. And I think it's very likely tomorrow or the next day, very, very shortly, we are likely to see the S&P 500 push to a marginal new high, unconfirmed by the Dow Jones Industrials, unconfirmed by the Dow Jones Transports, unconfirmed by the NASDAQ, and unconfirmed by the New York Composite. If we get that as a market technician, that would be icing on the cake. That would be a classic topping structure, where over the course of 7 weeks or so, we saw the big five major indices peak out at various points in time, with a solo event occurring with the S&P 500 being the last among them to make a new all-time high. And then from that point, we see the market averages begin to roll over. That's my preferred scenario. I think it's going to occur here very, very shortly, but we shall see. We shall see. And if it does, then we need to take steps to manage the risk.
So what you're telling us is the SPY, basically S&P 500 index, is the only one to not have the high in the rearview mirror? All of them have not?
Well, right now, looking in the rearview mirror, all of the major five indices have made record highs. The last of which occurred on November 22nd. We saw the S&P 500 and the NASDAQ Composite make their all-time highs. What I think is likely to occur here very, very shortly, like within the coming days, I think we will see the S&P 500 make a fresh new all-time high, unconfirmed by any other index. And then everything rolls over and heads south. The reason the market hasn't headed south yet is because the topping structure is not complete. And tops, as I said, are usually formed by seeing a fewer and fewer number of stocks and benchmark indices going to new all-time highs. And it appears that's what we are seeing right now develop. Now, what would obviate all this? Well, the market continues northbound, and we see all of the benchmark averages go to fresh new all-time highs. That would obviously invalidate what I'm conjecturing would be occurring here very, very shortly. It's certainly possible the 7-year top doesn't occur until later next year sometime. and we have to be prepared for that possibility as well. I'm not pounding the table here saying 100%. We're going to see the market peak out in the next day or two. The best I can tell you and the audience is the evidence is very compelling, and we'll just have to wait and see what develops. But that's what we're watching very closely.
I mean, the market's very overvalued right now, and certainly due for a correction of sorts. So, what chart do you have next for us? Interest rates or
Yes, I thought we'd take a look at interest rates. Yes. Okay, are you able to see it on your screen? The
yes,
U.S. government 30-year
blow it
bond
up a little bit. Yeah.
Okay. All right, I can do that. I think I figured out what I have to do. I have to exit and reshare, but that's okay. We'll make that happen. There we go. We'll blow it up a little bit. This is the yield on the 30-year Treasury going back to the year 1800, Josh. And for our viewers on YouTube, they're able to see this very clearly. For our listeners on the radio, I'll describe what it shows. The yield on the 30-year bond goes up and down and up and down, but since the early 1800s, what has developed is a clear 40-year cycle in the major pivotal turns. For example, the last pivotal turn in this series occurred in October of 1981. 40 years prior to that, interest rates made a low in 1940. Before that, they made a low in 1900. Before that, they made a high in 1860. So approximately every 40, plus or minus about 2 years, interest rates have tended to make major pivotal turns. And when they do, those turns tend to run for long periods of time, not just years, they run for decades. We are right now 40 years from October 1981, when interest rates got up above north of 15%. And the chart structure would suggest that we probably saw the low point last year in the year 2020, and that was the 40-year cycle turn in interest rates. And from this point forward, interest rates are going to start clawing their way higher, meaning bonds are going to go lower. So we are, I believe, entering an environment that most of us today aren't used to. That is to say, we're going to see Treasury yields go up. We've been used to, for the last 40 years, seeing them go down. But I think now they're probably going to trend higher. And then we might be looking at a significant high in the stock market as well. So all of those things together are suggesting that, maybe the easy money is behind us, and it's going to be a little bit more challenging as we go forward.
What about this? I mean, I've asked Lacey Hunt about your chart, no offense, and he said there's not enough data to really make a defined call on interest rates, meaning, of course, 40 years ago, 81 makes sense, 1940 makes sense, but like if you go back, you have 1830 and 1861. That's a 31-year different spread. And if you go even on your chart prior to 1861, there's not really a defined line. So the data is very weak. It doesn't really tell me anything. Just to play devil's advocate a little bit, Stan.
Sure. The data points are a little thinner to the left of 1860. Well, I don't know Mr. Hunt. I can't speak to what he is saying. But in my trained eye, I can see clear evidence of major pivotal turns at roughly 40-year intervals. If he has some data that suggests something to the contrary, I'd be delighted to take a look at it.
No, he was just saying there's not enough data to be definitive about the 40-year cycle. He actually sees that they could go a little lower. Now, he was one of the, he kind of claimed to fame saying that basically Treasury's yields would go down for 40 years in the 80s. So that's sort of his claim to fame. Other bond kings like Jeff Gundlach and Bill Gross made a lot of money the last 40 years basically buying Treasuries and just holding them forever. Your work would suggest that the market for interest rates interest rates go up, that would mean bonds go down. That would mean the Fed would lose control of the interest rates. How are they going to lose control? Or is it the whole thing of magnitude? So that could mean they just go up to 3 or 4%. It could be a gradual thing. Is it a magnitude thing, or is it the Fed loses control of interest rates?
Well, the worldwide market for Treasury bonds is much, much larger than the stock market. And the Federal Reserve will have to play catch up with what the worldwide market is doing. So if the worldwide market pressures interest rates higher, the Fed's going to have to play catch up. And I think that's what's likely to occur next year, is they're going to see interest rates ticking higher, and their modeling is going to show that they have interest rates too low compared to what the world market is pricing interest rates at. And they're going to have to ratchet rates higher to make sure that there is no distortion there. That's what I see developing. And what does this mean for you and me and all of our viewers and our listeners?
Well, that's a good cliffhanger. What does this mean for you, me, and all of our listeners when we return? Folks, give us a call, 888-988-JOSH for the year-end review. New year, new you. We just have 1 week left in 2021 for you to take action on Roths, traditional IRA. Get that extra write-off before the end of the year. Give us a call now, 888-988-JOSH, and you get the Income for Life Blueprint and Stan's latest market letter when you call us, and schedule and keep your no obligation review. Call us now, 888-988-JOSH, 888-988-JOSH. We'll be back after this. And we're back. This is Josh Jalinski, the Financial Quarterback, with Jim Nesto, doing a great job on the switchboard, and want to wish you all a blessed Christmas and a happy new year. So, Stan, we're going to go to home prices, but what does the interest rate thing mean for us? It sounds nice, but actually doesn't sound too nice, because I guess the market may look a little choppy next year. Interest rates may start going up. What does it mean? Make it practical for our listeners and viewers.
Well, sure. For savers, they're going to get more money for their savings. Rates have been very, very low. Savers have not been afforded much of a return on their savings money, but that is about to change. Good news for savers, of course. Bad news for people who borrow money for businesses and other things. Home prices, of course, are somewhat influenced by interest rates. Certainly, home buyers who are planning to take out a mortgage will find rates more expensive. I thought we would take a look at home prices and just get a clear sense of what is likely to occur here in the very near future.
Sure, let's do that. Take it away.
Here is the Schiller Home Price Index. Are you able to see that on your screen?
Yes, I can see it now.
Okay, terrific. This is Robert Schiller's work, which he makes available on his website. Anyone can download it. I download it, put it into a spreadsheet. And for the people on YouTube who can see the chart, one can see that prices have trended steadily higher since the 1940s. The chart is normalized such that the year 1890 is normalized to the number 100, and prices have been adjusted for inflation. For the listeners on the radio, what this chart reflects is, of course, home prices have risen from the late 1800s to the present, and right now the index is at about roughly 215, 216. It was at 100 back in 1890, and that's adjusted for inflation.
So, what does this mean?
Home prices are trending higher. let's bring it down to a shorter time span. Instead of looking yearly charts, let's look at monthly charts. And the next chart, and tell me please, Josh, do you have the national index on your screen?
Yes,
the
I can
chart?
see that now, yes.
Perfect. This is the Case-Shiller data, which any of us can download off the U.S. government's Fred website. It's free. You can download it into CSV format or Excel, dump it into a spreadsheet and graph it, and that's exactly what I've done here. These are monthly price bars all the way through the present. And from left to right, one can see that home prices have been trending steadily higher. A very, very simple buy-sell signal is evident here. I have plotted an 18-month moving average on the graph. And when the monthly price bars move above the 18-month moving average, a buy signal for real estate is rendered. And one can see that, in the early 1990s, price started advancing higher. The monthly bars moved above the 18-month moving average, and that was a buy signal. And that remained in effect until about September of 2006. Prices flattened out, and then they broke below that 18-month moving average. That was the sell signal right there. And prices trended south. Prices stayed below that 18-month moving average into early 2012. Prices stabilized and then moved back above that 18-month moving average, where they still are in the present. So the buy signal has remained in effect since 2012 for real estate. And prices, though, are getting a little bit frothy, and that's being generous. The rate of advance is something like we have never seen since data has been recorded. Prices are considerably overbought. I don't think we've topped out yet, Josh. I think we'll probably see prices trend a little bit higher into late next year, and then I think we're likely to see a peak in a peak in home prices, and then home prices are probably going to turn south from that point.
Yeah, I'll go on record. I think the top was probably this summer. I'm starting to see things cool down, but you're more of the cycles data guy than I am. I'm just kind of going with my gut. Last year we said, I said, hey, I thought we hit the low in interest rates. I'm going to say we're hitting the top now. I just don't see things going higher than they are now, except maybe in certain markets like Florida,
You make a good point. The housing market should be looked at like the stock market. So, for example, earlier we were talking about divergences developing in the stock market. The Dow Industrials peaked out in early November. Very plausibly, the S&P 500 within the next few days goes to a new all-time high, unconfirmed by any other index. We need to look at the home prices in the same manner. This is the national index. Think of it like the Dow Industrials or the S&P 500. It's a composite of the entire USA. What is likely to occur is when we get to the final cyclical top later next year, you might see the national index go to a new high, but various regions around the country will not go to a new high. On the East Coast, where we are, in the New York, Philadelphia region, maybe those prices do not go to a new high. But maybe out west, in the Phoenix and the LA markets, maybe they do go to an all-time high. So just like with the stock market, when we're looking at home prices and we're looking at charts, when we get to a final cyclical peak, we will see divergences develop. So that not all of the home prices all over the United States will go to a new high, but we will see fewer and fewer regions go to new highs, and that will define the final top.
And when we return, we'll talk more with Stan Harley. And folks, if you want Stan's latest work, call us 888-988-JOSH, and you get a free 45-minute review with Stan the man. He's been so gracious to offer his resources. He'll go over some of the charts, how they affect your own personal portfolio, and he'll see if your portfolio is at risk in these uncertain times. Give us a call now, folks, 888-988-JOSH, and you'll get a 2-for-1 special. You get to meet with me and Stan, and for the holidays, you get the book, The Income for Life Blueprint. Give us a call, 888-988-JOSH, 888-988-JOSH, 888-988-JOSH. And we're back. This is Josh Jalinski, the Financial Quarterback, and I'm with Stan the Man Harley. Stan, where's your latest chart? Are we done with all the charts?
Actually, I've gone through all the charts.
Okay.
We talked about the stock market. We talked about interest rates. We talked about home prices. And I think the compelling case can be made for a cyclical high in the bond market or a low in interest rates based on that 40-year cycle. And then for the equity market, I think a 7-year cycle peak is developing right now as we speak. Perhaps we'll see the S&P 500 go to a new all-time high in the coming days, and that completes the topping pattern. And then I see home prices continuing modestly higher and probably forming a final cyclical peak later next year.
And what about gold? I know you've done some work in gold, not lately, but what does your work on gold suggest?
Metals right now are not all that terribly exciting. They are, I believe, evolving in a basing structure. They're going, for the lack of a better term, violently sideways. So we've got gold not far off an all-time high. It was up in the 2000 area about a year ago, but it's down in the 1700 range now. The one index that's starting to concern me a little bit is silver. It's languishing the gold market rather noticeably. Longer term meaning a few years down the road, I see the strong likelihood metals are going to head higher. In the near term, I think we're going to see more sideways chop, a little up, a little down, a little up, a little down, but more sideways than anything. So not a lot of money to be made there on the long side, probably not a lot of money to be made either on the short side.
No, fantastic. So any parting thoughts for our listeners? I mean, you always talk about, I think one of the biggest three things is when you talk about three things that a good money manager needs. So if folks, are you listening, you're saying, well, what do I need to look for in a money manager? If you could talk about those three things, Stan.
Yes, Josh. I think to be successful in this business of investing, it's complicated. It's not so complicated that mortal man can't figure it out, but I think folks who try to distill this business down to being something simple, I think are doing a grave disservice to their clients, because the markets aren't simple. They are complex. One doesn't have to do all the detailed numerical analysis that we do here at the firm, of course, but nevertheless, there are still what I would contend are three skills that have to be mastered to ultimately be successful. The first one is what I call asset allocation or selection. Most firms are very good at doing that. What does that mean? It means picking the right stock, the right equity, the right ETF, the right index. And certainly a lot of work goes into that, but most folks, unfortunately, leave it with that. But there are two other skills that have to be managed very, very adeptly to be successful. The second one is what I call market timing or time series analysis. That is, okay, you've picked the right stock, a really good solid company, or the right index or the right ETF, but it's not just what, it's about when. I mean, you can buy a great company, but if you buy at a cycle top, you could find yourself underwater here very, very shortly. So understanding the timing, understanding the cycles, even in a simplistic fashion, just looking at charts and getting some assessment of, is this stock or this index too high or is it too low? That's market timing. It doesn't have to be terribly sophisticated, but one needs to employ some type of timing methodology. And then the third skill that has to be mastered is what I call risk management or money management. Okay, we picked the right stock or the right index or the right ETF. We've looked at the timing. How do we manage the risk? How do we manage the risk after we put the position on? How much do we go in initially? Do you take the whole wheelbarrow of cash and go all in? Heaven's sakes, no. I think it's prudent to go in incrementally. and let the market prove itself. Your analysis could be off. Maybe you picked the wrong racehorse. So if you go in incrementally, you go in small initially, and you manage the risk. If you find you've perhaps not made the right choice or your timing is off, you can get out with a small loss. Or if the position proves itself, then you add to accordingly. All of that is a little bit more complex. That's what we call risk management or money management. And it requires a successful blend of all three of those skills, I believe, to be successful as an investor or as a money manager.
No, fantastic. And what else would you recommend to listeners and viewers who are maybe looking for a money manager? What else should they be looking for?
I think investors should do their due diligence. They should, when they're interviewing a money manager, they should ask some serious questions and get a real keen sense of whether that manager has the requisite skills in picking the right stock or the right ETF. Does the manager have the timing skills? Not just buying a great company. That's great. A lot of money managers do that. But does the manager have the skills to know when the market's too high or when it's at a low point and the risk is much lower? And then last but not least, does that manager have the skills to manage the risk? How much to add, how much to subtract, when to buy, when to sell. That's all part of the risk management function. And I would suggest that an investor interview several money managers. And through the course of the dialogue that transpires, one will probably get a pretty keen sense of whether or not that manager has those skill sets.
No, that's fantastic. And Stan, for those of you who don't know, was a Top Gun fighter pilot. What is, they called you Hog, Stan the Hog Harley. So what did you learn as a Top Gun fighter pilot that prepared you for the world of investing? What was the number one thing you learned? And thank you for your service.
Well, I flew tactical. Thank you. It was my pleasure to serve. I flew tactical fighters, Phantoms, Tomcats, and Hornets off of aircraft carriers. Well, that's a very rapidly changing environment, as is the investing business that we are in. One has to move very quickly. One has to be aware of one's surroundings and manage the risk by all means. Sometimes if we got into a dogfight and things weren't going well, maybe it was appropriate to bug out. It's the same thing in the investing business. If you find yourself in a situation that maybe you're getting underwater, maybe it's appropriate to bug out, cut your losses short and move on to the next. A lot of parallels there between flying and money management.
Yeah, and Stan, and that's why it's great to have you on board. As I tell people all the time, there's nobody that I would rather have on our team, and you've been a great addition to our team as Chief Market Strategist, who could land, if you could land a plane on an aircraft carrier, you have the guts to navigate these markets. I mean, think about it, folks. You have Biden, you have Trump, then you have Biden, you have all this political uncertainty. You have COVID, you have Omicron, you have this, you have that, you have the vaccines, you have all this whole milieu that we're in, increasing government debt, which is a real problem. There's nobody I'd rather have on our team. So thank you so much, Stan, for joining us. Thank you for being a great member of the team. Merry Christmas, and a parting thought for our listeners.
I wish all of our listeners and viewers the happiest of holidays.
Happy Hanukkah, Merry Christmas, Happy New Year, and thank you, Stan Harley. And folks, call us 888-988-JOSH. If you want Stan to look at your portfolio personally, give you the top 5 tips from a perspective of risk, fees, and taxation. Remember, the name of the game is risk management. Call us at 888-988-JOSH for the free Income for Life blueprint. 888-988-JOSH, 888-988-5674, 888-988-JOSH.